There's a moment most people recognize but rarely talk about. You get your paycheck. You feel that brief sense of relief. And somewhere in the back of your mind you think, this time I'll actually put some aside. And then life happens. The rent goes out. The subscriptions renew. And by the time the month ends, there's just enough left to tell yourself you'll do better next time. Saving money was never actually designed to make you wealthy. It was designed to make you feel secure. You can be incredibly disciplined, cutting out coffee, skipping vacations, tracking every dollar, and still watch your financial position stay exactly where it is. The effort is real. The progress somehow isn't. That number on the screen feels stable. It feels real. But in terms of what it can actually buy you, it's quietly shrinking. At even a modest rate of 3 to 4% annually, money sitting in a standard savings account loses meaningful value every single year. The price of a grocery run that cost you $80 a few years ago might now run closer to $110. These aren't random fluctuations. They're the compounding effect of inflation working steadily in the background. Banks take in savings at a fraction of a percent interest and deploy that same money into loans and investments that return significantly more. As income rises, spending tends to rise with it, often at the same rate or faster. A raise leads to a nicer apartment. A promotion leads to a better car. The gap between what comes in and what goes out stays roughly the same. And the uncomfortable part is that this doesn't feel like a mistake while it's happening. It feels like progress. A nicer apartment after years of hard work feels earned. It's only later, when income has risen considerably, but the savings account looks almost identical, that the pattern becomes visible. The modern consumption environment is extraordinarily good at converting income into purchases before there's ever a conscious decision made. Subscriptions auto-renew. Notifications arrive at exactly the right moment. By the time most people think about what to do with their money, a significant portion of it has already been allocated. Not by intention, but by inertia. Instead of saving whatever is left at the end of the month, some people structure their finances so that savings come out first. Savings become a commitment rather than a leftover. When people do this consistently, they find that they adjust their lifestyle to whatever remains without feeling meaningfully deprived. There is a mathematical limit to how much anyone can save from a fixed income. Saving reduces outflow. It doesn't create new inflow. Historically, diversified market investments have returned somewhere between 8 and 10% annually over long periods of time. At that rate of return, money doesn't just grow, it compounds. The returns generate their own returns. Time becomes one of the most powerful variables in the equation, which means the earlier someone starts, the more dramatically the math works in their favor. Every year that money sits in a low-yield account instead of being invested is not a neutral decision. It's a costly one. The potential growth that doesn't happen during that period doesn't just pause and wait. It's simply gone. Because compounding is exponential rather than linear, losses in the early years are disproportionately expensive compared to losses later. A single decade of delay can cost more in long-term wealth than almost any other financial mistake a person makes. People often wait until they feel ready, until they understand the market better, until they have more to invest. But the conditions that feel like the right time to start almost never arrive fully formed. There's always a reason to wait a little longer. And in the meantime, the clock that matters most in investing keeps moving forward without them. Most people have a general sense of what they earn and what they spend, but very few sit down with real numbers. Patterns you can't see, you can't change. Spending that feels moderate often looks quite different when it's written down. The gap between what people think they're spending and what they're actually spending is frequently large enough to meaningfully change their financial trajectory. Clarity has a way of creating its own momentum. When people see their numbers honestly, not as a judgment but as information, something shifts. The abstract goal of being better with money becomes specific. The vague discomfort gets replaced with actual data. High-interest debt works directly against any effort to build wealth. A 22% interest rate on a credit card balance doesn't just neutralize the benefits of investing, it actively reverses progress. High-interest debt tends to grow faster than most people's ability to pay it down, especially when spending habits remain unchanged. What makes high-interest debt particularly insidious is that it often doesn't feel serious at first. But interest compounds in the same way that investment returns compound, except it works against you. The people who build lasting wealth are rarely those who earn the most. They're the ones who develop a clear relationship with how money moves through their lives, who understand that saving and investing serve different purposes, and who start earlier than feels necessary. Because in financial terms, earlier almost always means better. Wealth isn't built through frugality alone. It's built through understanding the difference between money that sits still and money that moves, and consistently, deliberately choosing to put more of it in motion. Most people spend their whole lives being careful with money. But carefulness alone was never enough to build wealth. It just kept people comfortable inside a system that was never designed to make them rich. The shift doesn't require a windfall or a perfect plan. It just requires seeing money differently, not as something to protect, but as something to put to work, quietly and consistently starting to use it that way. That's it. That's the whole game.